How to sweep away credit debt with infinite banking and save money in the process. This is a simple tutorial on a hybrid strategy that includes sweep strategy and snowball strategies, and using infinite banking tax-free cash growth warehouse as the base strategy. Aloha. I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Company Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy, and I'm the managing director of the Hawaii Financial Free Thinkers Academy, a nonprofit financial literacy education organization. For the past several years, I have focused on and specialized in the infinite banking concept and developing the tax-free cash growth warehouse finance strategy. So if you find this to be helpful, please like this video and subscribe to this channel. Also, please post your questions and comments here. For this tutorial, we will assume that you already have your infinite banking tax-free cash growth warehouse account established and is growing cash value for you. By the way, the hybrid strategy is one my wife and I have used and have helped clients with to great success. I want you to know that this is not just theoretical, but very real and practical. In fact, there's a chapter in my book, Nuts and Bolts, about this particular strategy. So anyway, our goal is to eliminate our credit debt. So the first thing we need to do is to get our information on all our credit debts all together. We need to list each debt, the total balance of each, and the interest rate charged for each. Also, we need to identify what type of interest is being charged, whether it's revolving, amortized, or simple. Credit cards generally charge revolving interest. Bank loans, including personal loans, car loans, mortgages, are typically amortized. Some personal bank loans are simple interest. Now, we need to look for the highest interest rate charged on each one of your targeted debts. And what is the minimum monthly payment for each? For the sake of simplicity, let's say we have 3 credit cards that we want to get paid off as quickly as possible. Credit card number 1 has a balance of $12,000, and the interest rate is at 12%. Minimum monthly payment is $200. Credit card number 2 has a balance of $6,000 and an interest rate of 16%. Minimum monthly payment is $110. Credit card number 3 has a balance of $4,000 and an interest rate of 18%. Minimum monthly payment is $80. Our total minimum monthly payment for all 3 is $390. Credit card number 1 has the highest balance, but also the lowest interest rate. Now, I found that for most people, it's easier to pay off the lowest balance debt first. In this case, it's also the highest interest rate, so that's good. Now, let's say you have $10,000 in your tax-free cash growth warehouse cash value available to leverage. You're going to take a policy loan against that, so you will be incurring another debt. The good news about that is you aren't locked into a minimum monthly payment. And if you're a client of mine, the interest rate for your loan will only be about 5%. Still, while you have enough cash value to be able to pay off both of the lower balance credit debts, you don't want to max out your leverage just in case something comes up while you're paying everything else off. So let's take a policy loan for $4,000 and pay off credit card number 3. Get rid of that sucker, get it out of the way. Now, credit card 3 has a 0 balance, and now your total minimum monthly payments are just $310. At this point, you want to put that $80 monthly payment you were paying to credit card number 3 towards credit card number two. You can let your policy leverage loan ride for a few months if you want, or you can pay whatever is comfortable toward that whenever you want to. If if you don't pay anything at all on the policy loan, in a year from the date you took the loan, you will be billed for the interest on the loan, and that will need to be paid. But again, if you're a client of mine, you'll also have been earning at least 6% on your cash value. So if needed, you can just add to your policy loan to pay the $200 interest bill and carry on. When your available cash value has grown to at least $8,000 again, now we want to take another policy leverage loan to pay off credit card number two. You've been paying $190 a month on that, but maybe you've been using that credit card to make a purchase here and there, so the balance has remained close to $6,000. Whatever the balance is on that card, if it's gone down, great. If not, well, take a policy loan for $6,000 and pay that sucker off. Okay, let's go to this slide here. Now you've got an additional $190 a month to pay toward that monster credit card number one. You've been paying your minimum $200 a month on that card, so the balance has gone down to around $10,000 by now. And now you're going to be paying $300 a month on it, which will cut it down considerably faster than ever before. Now you may be thinking at this point, but now I have a $10,000 debt to my policy loan. Where's the big advantage? Well, here it is. You were being charged 16 and 18% interest on those two debts. Now they're both at zero balance, and you're saving all that interest charged. Yes, you now have a $10,000 debt to your policy loans, but if you're my client, again, interest on that is just 5%, and you're earning 6% or more on all your cash value, not just the leverage free portion of your cash value. So really, the policy loan balance is interest free and your cash value is growing. So that is the beauty of the sweep strategy. You move or sweep a higher interest debt to a lower interest debt and save the difference while paying off the total debt faster and without paying any more. And of course, using your tax-free cash growth warehouse account as your sweep account gives you a net minus interest on the debt because you're earning more interest than you're being charged. No other account can do this for you. Tax-free cash growth warehouse strategy, baby. Yeah. On top of that, this is a kind of a side benefit. When you pay those credit card debts off and you keep the credit cards, don't close the accounts. Your credit score is going to go up because your credit usage is way less than your credit availability. Policy loans are not reported to the credit bureaus. Okay, where were we? All right, now we have just one credit card debt left on our hit list, and the balance is now down to $10,000 or less. So depending on your budget, you keep paying the $390 a month on that big bugger until you have at least $2,000 or $3,000 more in your available cash value than the balance on that last credit card. Then, you guessed it, you take a policy loan for the amount of the remaining balance on that credit card and pay that sucker off. Woohoo! Happy dance! Yeah. All right, now you have a policy loan balance of around $15,000, give or take. Now you start applying that $390 a month to that policy loan and get that cash value availability built back up. So it's available for the next thing you want to finance or sweep away. That's it. It's really simple. And boy, is it ever a huge advantage to have this strategy at your fingertips. Again, if you found this to be helpful, please like this video and subscribe to this channel. Also, please post your questions and comments here. You have questions, we have answers. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. The link is in the description box below. The link to buy my books on Amazon.com is also below. If you'd like to book a free phone consultation with me, the link to my Calendly page is also below. If you'd like to apply to become a client of ours, the link to the application is below. We're here to help. We look forward to helping you. Aloha and mahalo for watching.